Okay, so in this video, we'll be discussing about the measurement of financial liability. Okay, so as far as the financial liability is concerned, you have to value it at the net proceeds received from issuing the loan or the bond or the debt. Okay, so a financial liability is initially recognized at its fair value, which is usually going to be the net proceeds of the cash received. Because when you're taking a loan, you're issuing a financial liability. Whatever amount the company will receive after paying all of its issuing cost, it's at that value you are supposed to initially record a financial liability. So let's suppose in this question, okay, it says a company issues 4% loan notes. So this basically means that the company is borrowing the money. So if it says a company issues, it means that the company is taking a loan. Or if it says a company invests, so it means that then in that case, it becomes a financial asset for the company because they are investing or they are providing the loan to the other company. So in this case, as you can see, it's written a company issues, which means that the company is taking a loan for 4% with a nominal value of $20,000. Okay. So the notes in total have a 20,000 nominal value, and the interest to be provided to the investors would be 4% every year. Now, the loan notes are issued at a discount of 2.5%. Now, when it says discount, actually, it means that though the company is saying that we owe the investors 20,000, but it's not actually 20,000 what they have received from the investors at the time of taking the loan. They have received it's in this case it's going to be 97.5 percentage, like 2.5 percentage has been given as a discount. So after the deduction of that 2.5 percentage, the rest 97.5 percentage is what they have received. So the investors have got a benefit over here of 2.5 percentage, and the company has received less money, or you can say that they have given a discount in this case. Okay, so it's a cost to the company. And then there was $534 of issue cost was also incurred. So if you want to calculate the initial value at which you're going to record your financial liability, it will be at the net proceeds. Okay. And for this, what you have to do is you will take the nominal value of the loan note, which was 20,000. You will deduct the discount because that's the amount which the company has not received, which is at 2.5 percentage of the nominal value. So 20,000 into 2.5%, you get 500. So 500, they have received less basically, but they do say that we owe the investors at 20K. Okay. And then there are also your issue cost, which is 534, right? So that you also need to reduce. And then the final net proceeds would be around 20,000 minus 500 minus 534. So you basically get 18,966. So that's the net proceeds what you have, or the value at which you are supposed to record the liability, the company. Okay. Now the loan notes will be repayable at a premium of 10%. So when the time will come to repay back the principal amount, instead of 20,000, the company will return back 10% more. So they will return a total of 22,000. So they have taken only 19,500 from the investors, but then they are returning 22K. 20 is basically the nominal value, so that was 500 discount, and then the other 2,000 is for the premium after 5 years. And the term of the bond is basically 5 years. The effective rate of interest is 7%. I will quickly explain that how we got this 7% also. Okay, so that's the total. When you say effective rate of interest, it's actually the total cost of the loan, which to the company is 7%, because you see that the 4% only covers up for the interest which they will be given every year. That's 4%. But there is an additional 3% increase in the cost of the asset. That is because of the discount being given, the issue cost, as well as the premium. So these three things have caused the the cost of the bond to increase from 4% to 7%. Okay. So now, as far as the initial recording is concerned, you will say debit cash with the amount of 18966, and you will credit your financial liability with the amount of 18966. Okay. So that's the initial measurement, which they have asked you at the start of this question, that what amount will be recorded as a financial liability when the loan notes are issued. So it's basically going to be at the amount which the company who is issuing the loan notes have received. After that, now we will have to work out for the subsequent measurement. Although in this question, they have just asked you to show it for year one, but I will be doing it for all the 5 years. So you actually understand the concept of that 7% and how you're supposed to do it. Okay. So in this case, now for the subsequent measurement, it's better that we kind of make up a table. So this is going to be for 5 years. So here it's actually your opening balance, or the starting point, which is you record the liability at 18966. Okay. I'll just add up one more for the years over here. So I'm adding it to one more column, and this one is giving me the year. So 1, 2, then 3, and then 4, and then 5. So on this opening balance, there's a cost, which is the finance cost, and this has to be at the effective rate, because that's the percentage you're going to use, which will reflect the total cost of the loan note to the company, which is going to be at the effective rate. Okay. And then you will be paying interest paid, which is at 4%, which is your nominal value. And lastly, you will get the closing balance, which is going to be reported at the end of the year in the balance sheet, right? So on this 18966, the first year you have to 18966 into 7%. So the expense for the first year will be 1328. Like, I'm just rounding it up. So 1328. And then the interest paid will be 20,000, uh, and that's going to be at the rate of 4%, which is the rate at which they are paying you the interest. So that will be 4% over there. So 20,000 into 4%, I believe you will get 800. So that's the interest payment. Okay. So the accrued expense for this loan note is 1328, but because you have paid 800, the company has paid 800 in terms of interest. So now it's like a balance of 528 in this case. So the total closing balance will be, you will take your opening, which is 18966 plus 1328, and then minus 800. So you will get 19494. 19494. That's going to be the closing balance. Likewise, we can do it for the next year also. So it's going to start at 19494. And then again, you're going to apply 7% on that, which will give you 1364. That's the second year finance cost. Again, there would be a payment of 800. And then you will get your closing balance, which is going to be 19494. Then you add up 7% and then minus 800. So it will give you 20,059. Okay. Likewise, we can do it also for the third year. So we take 20059. Again, you will apply 7% on that. You will get 1404. Okay. and you will get again you will make a payment of $800 interest. That's the third year. So 20059 plus 1404 minus 800, you get 20663. Okay, that's for the third year. Then you will start for the fourth year, 20663. Obviously, the exam won't be asking you for all the 5 years. They will just they can start at, let's suppose, at the start of the sorry, at the end of the first year, and they might just ask you to do for the second year. Okay, so 20663 into 7%, you get 1446. That's the expense for the fourth year, and then you will have to make a payment of 800 interest. So 20663 plus 1446 minus 800, you get to 21309. Okay. And lastly, the last year, 21309. And again, you apply 7% on that, you get 1492. That's the last year expense. And now, if you see, in the last year, the company has to pay obviously the interest. They will obviously pay the principal amount, which was 20K, and they will also pay up the premium. Okay, so the premium was 10%, so that's 2000. So if you do it, I mean, you will get here a balance of zero, because at the end of the fifth year, the entire loan has been net off. So 21309 plus 1492, I get 22,800 and one, but you can ignore that one just because we have round off the figures. And here also, if you see the payment, it's 22,800. So it's approximately it's by the end of the year, it's exactly zero, and your liability has been paid off. Okay. So now this was your initial entry, which you did cash debit by 18966 and financial liability credit by 18966. But then subsequently, you need to record two more entries over here. Okay. Which is basically for the interest expense. So I'm going to say debit the finance cost, because this finance cost of 1328, let's suppose in the first year, will be a part of your income statement. Okay, so I'm just going to add it up over here. This is going to be a part of the income statement. Okay, and finance cost debit by 1328, and it will be a credit of financial liability. Your liability is increasing because of the accrued cost, which is 1328. And then you will also have to pass another entry for which you are paying up the interest. So this is going to be part in your cash flow statement where you represent your interest being paid. So that's only 800. Okay. So for this, it will become debit. It will be your liability, because your liability is reducing with the amount of 800. And then it will be uh, credit your bank or cash, because that's what you have paid for it. Okay, so the cash balance reduces or the bank balances too. Anyways, so this is basically the two subsequent entries you need to do. And likewise, the closing balance will be reflected in the balance sheet. Okay. So by the end of the first year, you will be showing up your liability at 19494, and likewise 20,059 for the second year, and so on. Okay, and it will be as a non-current liability for the first year, second year, third year, and then the fourth year. But at the fourth year, it will then become as your current liability, because you have to net it off in the next year. So first year, second year, third year, it's going to be represented as a non-current liability, but by the end of the fourth year, you're going to show it as a current liability, because by the end of the fifth year, you need to net it off. So that will become a current liability if you are making the accounts for the fourth year. Okay, so now I will just do a very quick verification for you over here. See here, if you look up at the total in expense, what we have recorded for this bond is 1328 plus 1364 plus 1404 plus 1446, and then 1492. So I basically get a total expense over here of 7034. Okay, which I have been recording it for the past 5 years. And to verify it, if you see that if the when the company took the loan, they gave a discount of 500, right? So it should be equal to all the expenses. So 500 was given as a discount. Okay, 800 is basically the interest for 1 year. So for 5 years it will become a total of 4000 interest which has been paid, right? And then there's a issue cost also of 534, and then there is also a premium of 2000. So if you add up all of them, you exactly get 7034. So these were the four different costs of issuing the loan note to the company, which has been recorded on an accrual basis over the period of 5 years. And that's what you call it as the amortization method. And normally all financial liabilities are recorded at the amortized cost way, except for few which are not in your financial reporting syllabus, which will be recorded at fair value through P&L, which are liabilities held for trading, for instance. So that's something which we can discuss in strategic business reporting paper. But for now, we are covering up with the financial reporting syllabus, and the only liabilities you have are those which will be recorded at amortized cost method, and majority of them are done at this method. Okay. So this is 7034, which was a reconciliation of all the five finance costs which you have written over the period of 5 years for this loan note, right? And yeah, and if you see one more thing to verify it for you, I mean, I have paid a cost of 7034, I mean, the company, over the nominal value of 20,000. Okay. The loan amount is 20,000, and the cost what the company has paid is 7034. So this makes it up to 35 percentage approximately. Okay. So 35 percentage is basically the cost of this bond, overall cost of this bond to the company. And because it was for 5 years, so if I divide by 5 years, I exactly get that 7 percentage, which was the effective rate. Okay. So that's how the effective rate is calculated, and you need to amortize it over the 5 years period. So right now what we have, the next topic is preference shares. Okay, now let me explain you about the preference shares. Preference shares can be of two different types. Number one, it's considered to be as redeemable ones, where the principal amount is also paid back to the investors until the principal amount is not paid. You get a fixed dividend every year. So it's like just like a loan note. The thing is that the name is changed. Okay, we call them as preference shares. And if they are redeemable ones, it means that the investors are going to get a fixed dividend every year till the principal is not repaid. Okay, so if it's a redeemable preference shares, you're going to consider it to be as a financial liability, and the same rules will apply as I have explained you before. Okay, at the start of the video. So loan notes and redeemable preference shares would be treated exactly the same way, because both of them are financial liabilities and the company has an obligation to pay something to the investor. In loan notes, it was the interest, it was the premium, it was the nominal value. But here it's a fixed dividend every year, and then you also have to pay the principal amount. So it's almost exactly the same thing, just the names are different. Legally they operate in a different way, so we are not going in the legal perspective. What we need to consider over here is from the accounting perspective. So the treatment for the redeemable preference shares and the loan notes is exactly the same. However, for the irredeemable preference shares, you need to see that what's the contract saying. In case if the investors have a right to receive dividend every year, okay, in that case, it becomes again a liability. Irredeemable preference shares means that you will not be getting the principal amount. However, there can be an option where you might get a dividend every year forever in perpetuity. If that's the case, then again it becomes a financial liability for the company and the accounting treatment will remain same. However, if the directors or the company is under no obligation to pay you the dividends, then it becomes an equity. It becomes preference shares, irredeemable preference shares, and you can consider it to be as an equity. And if you are paying dividends on those type of shares, it will be considered not to be as a finance cost. It will be considered to be as an appropriation of profit, and then you can reduce it from the retained earnings as you do it in the case of ordinary dividend. So you actually need to understand the substance of different types of preference shares. So how are the irredeemable preference shares, which have a no right of fixed dividend every year, different from ordinary share? Is that in case if the director decide to give a dividend, first priority will be of the preference shares, and later on, if the cash is left, then they might prefer towards ordinary shareholders. The same thing happens in the terms of liquidation, that first priority is given to the preference shareholders, which are irredeemable and they had not any right to receive a fixed dividend every year. And then, if something is left, that's to be provided to the ordinary shareholders. So as you can see in this question, okay, it says on 1st of April 2007, a company issued $40,001. It's the nominal value. It's redeemable preference share, so it becomes a financial liability with a coupon rate of 8% at par. So every year, I mean, you will be getting 8% interest or a fixed dividend. They are redeemable at a large premium, which gives them an effective finance cost of 12% per annum. So, because the premium is involved, the cost of this preference shares, redeemable preference shares, increase from 8 to 12%. Okay. We are not going to be doing it for its entire life, because in the question they haven't provided you with for how many years it is basically. But they would say that how would these redeemable preferences appear in the financial statements for the year ending March 2008 as well as in March 2009. So we actually need to work out only for 2 years. So here it is how we're going to be doing it. Okay. So here it's your opening balance, which in this case, because we don't have an issue cost, we don't have any kind of discount over here, so this will actually begin at 40,000, but then you have the finance cost over here. Though you call it as preference dividend, but I'm not going to take it in statement of changes in equity. I'm going to be taking it as my finance cost, as my interest expense. Okay, and then you have the interest or the dividend paid, and then you get the closing balance, right? So 40,000, that's your opening, and the finance cost will be charged, as I told you, that it will be charged at an effective rate. So 40,000 into 12 percentage, that's 4,800. So that's going to be a finance cost to be charged in the income statement for the year ended March 2008. The interest paid is at 8 percentage, so that's going to be 3,200, because 40,000 into 8 percentage, you get 3,200. So that's the interest paid over there. And lastly, you will get the closing balance, which will be 41,600, I believe, if I'm not wrong. 4,800 minus 3,200, you get 41,600. Yep. So 41,600 will be the closing balance of this redeemable preference shares towards the end of March 2008. And then you can also do it for the next year, which is 41,600. Again, you're going to apply finance cost at 12%. So this will give you 4,992 expense for the next year. Again, there is an interest payment of 3,200, and you will get your final answer, the closing balance for this redeemable preference shares, at around 43392. Okay. So 43392, that's the closing balance of this preference shares in the balance sheet. So as far as the exam question or an MCQ is concerned, they might just ask you that what will be the finance cost charge in the second year, or what will be the closing balance by the end of the second year or third year, something like that. Okay. So now the next thing what we have over here is a compound instrument. Okay. Now a compound instrument is a type of a contract, or it's a financial instrument that has some characteristics of both the equities and liabilities. So the normal example which you can get in your exam for a compound instrument will be a convertible loan. Now in this type of a instrument, or in this type of a financial instrument or a contract, the company has issued it, the company wants money, but they have given the investor an option that instead of taking the principal amount back, they can take the shares of the company. So it's up to the investors to decide whether they want to take the principal amount back, or let's say they are too happy or too satisfied with the performance of the company over the loan period, and now they have decided to become the investors of the company. Okay. So because you have given them the option to do it, right? So it has the element of equity, and it also has an element of liability. So a convertible loan note should have the following characteristic. Like these type of question can be tested in theoretical part. So it is repayable at the lender's option, okay, in shares of the issuing company instead of cash. So at the lender's option means the investor's option. Either they can take it in terms of cash, or they can take it in terms of shares. So it's up to them. But how many number of shares they will be issued or they will take will be decided at the start of the agreement. So that's to be decided when the company was issuing the compound instrument or the convertible loan. And because the investors have an option that they can convert it in the shares of the company, okay, the interest what they will be paid during the loan period will be less as compared to the market rate, because I mean they won't be getting the market interest, because they also are having an option to buy the shares of the company, like to receive the shares of the company instead of their principal amount. So the interest what they will be getting during that period will be less than what is being offered in the market rate. Okay. So now here we have a question over here. So we'll try to solve this question. Okay, and it will explain you that how you are supposed to record the convertible bond, convertible loan note, and subsequently also. So in this case, the company has issued a convertible loan, so they are the one who needs the money. They have issued a convertible loan that pays interest of 2% per annum in arrears. So basically they are getting 2% interest only, which is very low because the market rate is at 8%, being the interest rate for an equivalent debt without the conversion option. So if because you have the conversion option, I mean you're just getting an interest rate of only 2%. Okay. Think that you are the investor and I'm the party who is issuing the bond, the loan, the convertible loan. The loan of 5 million is repayable in full after 3 years, or it can be converted to equity. Okay. Discount factors are as follows. So the discount factors have also been provided. Now, please see over here, debit will be cash, okay, because the company has received cash of 5 million. That's the asset, right? But now it's not considered to be as 100% financial liability. As I told you that it has both the elements. So it will be credit, like there are two credits over here. So one credit will be your financial liability, and the other credit will be an equity option which you kind of recorded in your other components of equity. Okay. So because you haven't issued the share, so you cannot record it in the share capital, the main share capital of the company. However, you're going to record it as your other reserve, other components of equity, where you will write it down like share premium or equity option, for instance. Okay. So now once when we have the value of the liability, that's what you need to calculate, right? You can get the value of equity, because if you have the value of the asset, which is 5 million, you subtract the value of liability, net, you will get the equity, which is going to be the balancing figure, right? So to figure out the value of liability, you have that's the formula. You have to take the present value of the interest payments and the principal, okay, discounted at the market rate, right? So now, if you look up at this, like this is what I need to explain you. Okay, this is what you need to keep in your mind, right? So the interest what this bond is basically giving is around 2 percentage, right, of 5 million. So you see 5 million into 2 percentage, so that will be around point 100,000 basically. Okay, so that's like 100,000 interest, which will be there for 3 years, because it's for 3 years after repayable in full after 3 years. So the term of the bond is 3 years. So after 3 years, either you take the 5 million back or you can convert it into a fixed number of shares, right? So the interest is 100,000, right? So now you see you have two parts over here. One of them is the interest and the other one is the principal. Interest works in an annuity. It's like a fixed amount of 100,000 for 3 years. So first, let me work up for the interest rates, okay? The interest basically. And see, in the exam, they might give you the discount factor at 8 percentage and at as well as 2 percentage. So that's purely just a confusion for you guys. You need to find out the value of anything. Like I'm trying to find out the market value of the liability. So for that, I have to take the market rate, the not the discounted one, which is at 2 percentage, right? So ignore that 2 percentage discount factors in case if they would have given it to you in the exam question, which they normally do. You just take the factors which are at the market rate. Okay, so now because the interest is going to be in annuity, okay, so what I can simply do is I can just add up all the discount factors and I will get the annuity factor, because annuity factor is the sum of the discount factors, right? So if I want the third year, like it's a 3 years annuity, so I will take 0.926 plus 0.857 and then 0.794. So this will give me an annuity factor of 2.577. Okay. You can use the formula, which is 1 minus 1 plus r to the power minus n, then divide by r to find out the annuity factor. I mean, you don't need to figure out these tables and stuff like that. So the point what you need to remember is that for interest, you have to multiply it with the annuity factor. Annuity factor at 8 percentage, yeah, 3 years. Okay, it's a 3 years annuity. So that's what you will be multiplying it with. So you get 2.577 multiplied by 100K, 100,000. So that is 257700. And as far as the principal is concerned, it's not in annuity. It's actually like 5 million, right? And 5 million, and you will take the discount factor for it. So the discount factor is already given to you in the question. For the third year, it's 0.794. So you will multiply it by 0.794, which is actually the discount factor at 8 percentage for the third year. Okay. So this will give me 5 million multiplied by 0.794. I'll get 3.97 million over there. So to find out the total value of the liability, I just need to add up both of them, right? So this is 3.97 million, and the other one is 257700. So if you add them up, so the total value of liability will be the add of both these things, 3.97 million. And then you also have your 257,700. So this will give me a total of 4.2 million approximately. So I'm writing it down the exact figure, 4,227,700. So that's the actual value of liability. So for this one here, the financial liability will be credited at 4227700. Okay. So the balance, because once you have the asset value, if you subtract the liability value, you will get the equity option value, which is actually going to be the difference. So if I subtract 5 million from there, So you get 772300. That is considered to be as an equity option. So here, if you look up the question, they ask you that split the loan between the debt and the equity at inception, right? So the total asset, the cash is 5 million, and if I split it into the financial liability, it will become 4.227700, and the remainder will be an equity option, which is 772300. Okay, so that's how you're going to split it. Now, this will remain in the other components of equity till the 3 years, until it's been decided that whether the shares will be whether the note will be converted into shares, or there will be a principal repayment. Okay, so by that time it will remain in the other components of equity. As far as your syllabus is concerned, you don't have the entry what is going to happen at the end of the third year. So let's assume that it will be a repayment of 5 million, and we won't have any conversion of the shares. If you talk about the conversion of shares, I mean, that's actually a part of the SBR syllabus over there, right? So right now this video is focused only on the financial reporting syllabus, so I'm just going to stop till here. Okay, so now once you have your financial liability over here, for this you can use the same amortized cost method which I have already explained you, and you can record it. Okay, so let's suppose for the first year, okay, we can make up the same table, right? So let's do it for 3 years to help you understand, right? So the opening balance over here, then you have the finance cost on that, then you have the interest paid, and then lastly you have the closing balance, right? So your opening balance of the liability is 4227700, and on that the finance cost will be at the market rate or the effective rate, which is actually 8%, right? So 4227700 into 8%, you get a finance cost of 338216. Clear? And then you have an interest payment of 100,000, which, if you remember, was at 2%. So in this case, it will be a negative of 100,000, right? So that will give you your closing balance of 4227700 plus 338216 minus 100,000. So this will give you up to 4465916 as the closing balance of the liability of the convertible loan note. Likewise, you can do it for the next year. So it will become 4465916. And again, you're going to apply the rate of 8% onto it. So this will become 357273. Then again, there is a payment of 100,000. Okay. And so now the balance will turn out to be 4465916 plus 357273 minus 100,000. So this will give you around 4723189. And this is now the last year. So it will become 472, sorry, 3189. And then again, you're going to apply 8% on that. So it will become 3777855. Okay, so 377,855. So that's the expense for the third year. So if you add up 4723189 plus 377,855, so I approximately get like around 5,10,000, 5,101,044, just because of the roundup. But now it's up to the company to it's up to the investors to decide that what they will do. Okay, so if they, let's say you will pay them 100,000, okay, and this balance over here will become supposed to be exactly at 5 million, but I just have a difference over here of 1044. That's just possibly because of the rounding up. So here the balance will be 5 million. Now, then it will be decided that whether this 5 million has to be paid or it will be converted into the shares. But that entry is really not in your syllabus, so you don't need to worry about. What's the focus of your syllabus right now is how to split out the total money which you receive from the issuing the convertible bond between the equity element and then the liability element. And then for the liability element, how you are supposed to amortize it, like how you did your redeemable preference shares or you did with the loan notes at the start of the video. It's exactly the same way.